Hello, welcome back. We're now going to continue on our second chapter of the notes by having a look now at what is known as the accounting equation. Now, the accounting equation is just a simple expression of what we already saw back in our last session where we looked at the statement of financial position. Now, remember, a statement of financial position was a snapshot at a moment in time of the company's position in terms of what it owns through assets and what it owes through capital and liabilities. Now, we said that the top half of the statement of financial position, total assets, must equal the bottom half of the statement of financial position, capital plus liabilities. Now, in order for that to work and for both the top and the bottom half to balance and always be equal, what we can do is look at the accounting equation to help us record transactions so then that the statement of financial position will always balance. So, let's have a look at this accounting equation. We can see then that the accounting equation says that all your assets in the business must equal capital plus liabilities. It's just a simple expression of the statement of financial position we saw in the previous session. So, we know the different types of assets, liability and capital. Now we need to be able to take transactions, record them into the accounting equation in order for the financial statement, the statement of financial position, to indeed work. Now, in order for this accounting equation to work, we need to focus on some key principles. So let's take a look at them. So we have two key principles that we need to look at: the dual effect principle and the business entity principle. We'll start with the dual effect principle. What we say with the dual effect principle is when we are recording transactions and events in a business, every transaction must have an equal and opposite effect. So a dual effect. So every transaction in the business must have two effects. And they must be equal and opposite. So think of it like a set of scales. They must always be equal. Okay? That's our first principle. Our second principle is the business entity principle. And what we assume with the business entity principle, for accounting purposes, is that the owner of the business and the business itself are completely separate entities when we are recording owner transactions. For example, if I own a business, okay, so let's say I set up a plumbing business, and I invest £40,000 of my own cash into that business, well, from my perspective, I would have £40,000 less cash out of my bank account. But for accounting, we're not accounting for me, we are accounting for the business as a separate entity. Now, thinking about it from the business perspective, the business would have £40,000 more cash, which has been invested by the owner of the business. Do you remember, amounts invested by the owner is called capital. So the business would have more cash. Do you remember, cash was an asset? But also, ultimately, the business would owe that back to the owner by way of owner's capital. Okay, so that's the capital section of the statement of financial position that we discussed in the last session. Notice what I've done there. I've explained the business entity principle by keeping the owner and the business separate, but have you also noticed that I talked about the dual effect? The business has more cash and the business has more capital. £40,000, the dual effect. So, let's see how these principles would work in day-to-day transactions of a business and then apply it to the accounting equation in order to make sure that the owner's statement of financial position or the business's statement of financial position does indeed balance. Let's take a look at an example. We're going to start off with an example then. And the example is for KTP. Now, KTP is a sole trader and commences business on the 1st of July 2009. The following transactions took place in her first week of trading. So let's take a look at this then. On the 1st of July 2009, Katie put $20,000 cash into the business. On the 3rd of July 2009, Katie purchased a motor vehicle for use within the business for $9,500. On the 7th of July 2009, Katie takes out a 5-year loan from the bank for $5,000. And the requirement is, show the accounting equation for KTP at the end of the week. So, in order for us to be able to do the accounting equation, we need to think about those two principles that we discussed. So, let's write up the accounting equation first, and then we can apply that accounting equation and use it to record those 3 transactions. So remember, the accounting equation, our assets must equal our capital plus liabilities. Now, what I've done there is wrote up the accounting equation, but what I'm going to do is use that accounting equation as a columnar format. So a column for assets, a column for capital, a column for liabilities. So these are going to be essentially headings, and we're looking at amounts in dollars. Okay, remember this is an international exam, so dollars is the denomination of currency that would be used in the examination itself. Okay, now we've wrote up the accounting equation, we want to show the accounting equation for KTP's first week of trading. So let's have a look at the first transaction. The first transaction said, on the 1st of July 2009, Katie put $20,000 cash into the business. So remember, we're thinking about this from the business's perspective. What do the business now have? Well, think about it. The business would have $20,000 more cash. Now, if we were thinking about whether cash was an asset, capital, or liability, what column would you put it in? I'm sure you're all shouting at your screen. You're all saying it's an asset. Great. So let's write that down. On the 1st of July 2009, Katie put $20,000 cash into the business. And I'm going to pop that in under the assets column. So we've looked at it from the business perspective. The business has more cash now. But the other principle that we need to apply is the dual effect principle. So at the minute, the scales don't balance. We have an increase in cash asset, but we need the other dual effect. Now, ultimately, the business owes that money back to KTP. And KTP, remember, is the owner of the business. She is investing money into the business. She's investing capital. So, under the capital column then, we're going to show an amount of capital invested of that same amount of $20,000. So notice then that I've got my asset and I've got my capital. The dual effect works. And as a result, if you do that dual effect, the accounting equation will also work. My assets will equal my capital plus my liabilities, which at this point was 0 because that transaction, the dual effect, has now been recorded. So there we go. That's our first transaction recorded, applying all those principles that we've learnt. So let's try another. On the 3rd of July 2009, Katie purchased a motor vehicle for use within the business for $9,500. Now, it doesn't say that she purchased that motor vehicle on credit, so promising to pay later. So we can safely say that she's used some of her cash in order to acquire that motor vehicle. So let's record that first. If she's paid cash, she's taken cash out of the business, therefore we are reducing our cash asset. So that would be a reduction under the assets column of the accounting equation. So, 3rd of July 2009, KTP's business cash asset has now fallen by $9,500. Okay, cash has gone out of the business, a reduction in that asset. But what does she receive in return? Well, she receives a motor vehicle. Do you remember how we said that motor vehicles was an example of a non-current asset? Katie's going to keep that in the business and use it within the business for the long term. So that's going to increase total assets. So we're going to pop that into the assets column. So motor vehicle as our asset. We're going to increase our assets column with the cost of the motor vehicle of $9,500. Okay, so there we have it. That's our second transaction now complete. And if you look at this accounting equation, our assets will still equal our capital and liabilities, because now that dual effect is recorded, that transaction had no effect on capital or liabilities. So the dual effect would still work, as would the accounting equation. So let's have a look at one more transaction just to finish this off. On the 7th of July 2009, Kate takes out a 5-year loan from the bank for $5,000. Now, if you're taking a loan out from the bank, you are receiving cash. Okay, you're borrowing money. So let's write that down. On the 7th of July 2009, Katie is going to have an inflow of cash to the business for $5,000. So KTP's cash asset would increase as a result. But remember, we need the dual effect. We need the scales to balance. So, what do you think the opposite transaction would be? Can Katie keep that money and never pay it back? No, it's a loan. She's got to repay it eventually. As a result, it's going to be a non-current liability because the question said that it was a 5-year loan. So, we need to increase the business's liabilities with that bank loan. So under the liabilities column, we're going to have bank loan. And we're going to increase the business's liabilities by $5,000. Okay. So my asset would equal my capital plus liabilities for that transaction, because there was no effect on owner's capital, and we've recorded the dual effect, the equal and opposite effect. So to prove that then, at the end of that first week of trading, KTP would now have $25,000 total assets, and that would appear on the top of the statement of financial position, and that will always equal her capital, which is just her capital invested, of $20,000 plus liabilities, the bank loan, the $5,000. So capital plus liabilities would obviously equal $25,000, which is equal to the owner's assets of $25,000. There we have it, the accounting equation, the dual effect, and the business entity principle now complete. Thank you.